Good afternoon and welcome on behalf of Nationwide Marketing Group to a Paycheck Protection Program update. We're very pleased to have joining us again today Jill Strickland from Constangy Brooks Smith and Profit, and we'll go over the latest updates on the Paycheck Protection Program. We'll also take your questions toward the end. You do have the ability to submit questions through the webinar, and we'll be happy to address those as soon as Jill finishes her presentation. So again, we're very happy that you joined us today. We thank you for the time, and we'll turn things over to Jill Strickland.
Thank you, Mike, and thank you all for being here with us this afternoon. I'm really pleased to be here and share some updates on the Paycheck Protection Program. And there have been many updates since the last time we got together. This afternoon, we'll start out by talking through the brand new Paycheck Protection Program and Healthcare Enhancement Act, and we'll just call that the Enhancement Act for short. This was entered into law on Friday, and we'll talk about it in a little bit of detail, but the big news here, of course, is that it appropriated additional funds for both the Paycheck Protection Program loans and also for the EIDL loans that are available through the SBA to small businesses. We'll review some guidance that we've received recently from the Small Business Administration and also the Department of Treasury. And we'll also identify some key important questions that still remain outstanding and that we hope the government agencies will provide some additional input on. And then finally, we'll review some very practical tips, some best practices for borrowers, whether you've already been funded with your FPP loans or whether you are in queue waiting to hear back from the SBA or your commercial lender as to whether you've been funded, or whether you're considering submitting an application now that there's been new funds appropriated. And then, as Mike said, we'll address any questions that remain outstanding at the end of the program. Just a quick overview. For those of you who've been on previous calls, you're very familiar with the PPP. The Nationwide Marketing Group has been sending out great information about the program. Basically, this is a featured relief program that's contained in the CARES Act, which was enacted on March 27th. Gosh, it seems like so long ago already. This is the Coronavirus Aid, Relief, and Economic Security Act. And it provided a number of programs, and one of those was this PPP, or Paycheck Protection Program, which was an originally $349 million loan program that was designed to enable financial institutions to make forgivable SBA loans to small businesses and other eligible borrowers. And the intent here was really to have the loan cover costs between February 15th of 2020 and June 30 of 2020 that were incurred during the business slowdown and in some cases shutdown that was necessitated by the coronavirus. The CARES Act also created separately a $10 billion grant program under EIDL, which was an emergency loan program that was already in existence, and this is operated directly by the SBA. Now, these loan programs were extremely well publicized and extremely popular. The application process began on April 3rd for small businesses and sole proprietorships, and then on April 10th for independent contractors and self-employed individuals who are also eligible to receive forgivable loans under the PPP. And the SBA essentially ran a full year's worth of activity in less than 10 days. By April 17th, both the funds that were appropriated for the PPP and the EIDL grant program had been exhausted entirely. The SBA numbers show that they made loans in this initial program to 1.66 million different businesses, and the average loan size was $206,000 per loan. But that money went fast and it went furious. And for those of you who were involved in applying for loans during that process, you know that it was a little bit of a circus. The SBA was asked to perform a pretty big job here. I mean, Congress essentially handed to the SBA the responsibility for creating in a very short time frame this emergency relief program and coordinating that with its commercial lenders. So we saw a lot of hiccups along the way. Huge lines in the commercial lenders of people who were borrowers who were applying for loans. The commercial lenders didn't receive guidance on how to process the loans until literally the night before they were supposed to start processing them. So they did get the applications in, they got the money out. There was a lot of confusion about how those were supposed to be done, a lot of inconsistencies among the various lenders. And there were, obviously a number of companies that got loans and a number of others are still waiting. I went the wrong way, bear with me. So last Friday, the Paycheck Protection Program and Healthcare Enhancement Act was made into law. So this was just enacted on April 27th. It appropriates an additional $310 billion for PPP loans. And basically, it did not add a whole lot by way of new requirements or new processes or new guidance for how these loans are to be administered. The most important thing about this law was the appropriation of the additional funds. This new law, the Enhancement Act, does say that of that $310 billion, $60 billion of that amount is to be earmarked for smaller lending institutions. And those include community development, financial institutions, minority depository institutions, and credit unions. And the idea was really to make these loans available to small businesses who might be in more rural areas or other underserved areas. The SBA resumed accepting PPP loan applications now that it's got the new funding yesterday at 10:30 a.m. And according to the SBA, they're reporting that they processed more than 100,000 loans from over 4,000 lenders as of 3:30 p.m. yesterday, the first day of the rollout. There are reports from many lenders that there are problems, again, with the website, problems getting onto the E-Trans system that the SBA uses, all kinds of technological difficulties with this volume going through. The Enhancement Act also appropriates $10 million for EIDL grants. And we'll talk a little bit more about those. We've covered them in some of the past webinars for those of you who are able to attend those. The SBA has instructed approved lenders to resume processing applications that were previously submitted, as well as taking new applications and to resume dispersing funds. So again, this program, like the first go around, is first come, first served. Yesterday, the first day of this new funding was available, the SBA reported that it was seeing double the volume that it did in the opening hours after the PPP's initial rollout. And primarily, I would suspect that's because the commercial lenders have continued taking applications even after the initial funds ran out. So the commercial lenders have a queue of borrowers who have applied to them, both while the initial funding was still available and after it ran out, and who are still waiting. So, and also the commercial lenders are a little bit more on the ball now, since they've gone through it one time in terms of what they need to do to get the applications together. There have been, again, reports of glitches, lenders having difficulty accessing the E-Tran platform. But I imagine those of you on the call really probably fall into three categories. One is you've already gotten your PPP loan approved. And congratulations, I know a number of you, a number of members of Nationwide Marketing Group are in that category, so congratulations. If your PPP loan has already been approved, you cannot apply for another one. This program is designed for borrowers to be able to get one loan and one loan only. But we will cover some information today about how to use and account for your funds and make sure you can take advantage of the forgivable portion of that, so stay tuned. If your application was already in queue but not yet funded based upon the initial appropriations for PPP loans, the SBA and your lender should be processing that on your behalf. One question you can ask your lender is, was there an ETRAN, E-T-R-A-N number assigned? ETRAN is the name of the system that the SBA uses. And if there's an ETRAN number assigned, you're in pretty good shape. That's a pretty good indication. No guarantees here, obviously, but ETRAN is the name of the system that the SBA uses. So if your loan got to the point in line where you were actually entered into the SBA system, hopefully that means you'll be early in line to get the funding approved this time around, now that there's been new money appropriated. So contact your lender. I'd advise see what's going on, see if there's an ETRAN number assigned, and find out where you are in the process. Make sure your lender has everything they need. If you've not yet applied for funds, you might be asking, gosh, is it, with all these people in line, is it even worth applying? We do anticipate that these funds will run out quickly. If you consider the average loan size of the loans that were made during the original appropriations for PP loans of $206,000 a piece, if that holds true, then more than $20 billion in new appropriations are probably already spoken for, based on the SBA reports that they processed more than $100,000 worth of loans yesterday. So we do anticipate that this money, like the first round, will go quickly. That doesn't mean that you should be discouraged from applying. The application process is relatively streamlined. It was designed to be that way in order to expedite getting money out to small businesses. The funds very well might run out, but it's not a bad idea to get yourself in line. And that way, if there's more money allocated by Congress, you'll already be among the small businesses that are in queue, and hopefully will be first up or earlier up the next time around. The number of applications that are filed but not funded is also a pretty good message to send to Congress as they evaluate, as I imagine they might in the future, whether additional funds should be appropriated for PPP loans. So that's a quick overview of the Enhancement Act. There are a few other goodies in there that relate to healthcare providers and funding for additional testing. But that's it as far as it relates to the PPP program and the EIDL loans. Since the initial rollout of the PPP program, the SBA has issued some formal regulations. These are called interim final rules. And these are the SBA's official interpretation of the CARES Act. So this is a step up from the information that you see on the SBA website, for example, as a frequently asked question. That's just guidance. These are actually the official rules and regulations. They carry a little bit more weight in terms of law. And these interim final rules were issued on April 14th. And they start out by talking about the intent of the CARES Act. And I wanted to cover this with you briefly because as we talk through some of the questions that the rules and the guidance have already answered for us, you'll see that the SBA many times went back to what the central intent of the law was. And that might be helpful to us as we're thinking through, okay, there are some open questions remaining. Of course, it'll be up to the SBA and in some cases the Department of Treasury or the IRS to determine what the answers are, but we can get a sense of what the likely answers might be based on the intent of the law. So the SBA in the final rules recognize that the main intent of the CARES Act was to allow the SBA to provide relief to small businesses throughout the country as expeditiously as possible during a temporary period of time during which our economy is disrupted by the COVID-19 pandemic. And the rules effectuate that intent by delegating authority to lenders, more so than usual for the SBA loan process, and also streamlining the requirements of regular Section 7A loans under the SBA, the Small Business Act. And throughout the regulations, the final rules, you'll see that the SBA recognizes that the overarching purpose of the Act seems to be keeping workers paid and employed. And you'll see that there are several new twists or new requirements that the regulations put in place that were not contained in the original Act that the SBA believes effectuates this overarching purpose. One of the most significant new items that came out in these final rules, and this is not anywhere in the CARES Act at all, this is something the SBA came up with, not Congress, is that not more than 25% of the forgivable amount of a PPP loan may be attributed to non-payroll costs. So even though up to the full principal of the loan is forgivable, and we'll cover again how the loan forgiveness process works and talk through some open questions on that. Even though the entire amount of the loan is forgivable, certain requirements have to be met. And the loan amount has to be used for certain purposes during the 8 weeks after the disbursement of funds. The new rules create this new rule, a brand new requirement, that not more than 25% of the loan forgiveness amount may be attributable to non-payroll costs. So at least 75% of the amount that will be forgiven must be attributed to payroll costs as defined by the Act. And the other 25% can be made up of other allowable uses, such as mortgage interest payments, rent payments, and we'll cover what those are. The way that the SBA got there is that they determined that 75% of the loan proceeds is essentially the equivalent of 8 weeks of payroll. And so they thought that this requirement of having the vast majority of the forgivable amount of the loan proceeds used for payroll costs would be consistent with the overall intent of the Act. There is a provision in the regulations that says that at least 75% of the PPP loan proceeds must be used to cover payroll costs. This is a little bit different. One section says not more than 25% of the loan forgiveness amount may be attributable to non-payroll costs. Another completely different section entitled How Can the PPP Loans Be Used says that at least 75% of the PPP loan proceeds must be used for payroll costs. So that suggests that the 75%-25% ratio, with 75% used at least on payroll costs and no more than 25% on other allowable costs, applies regardless of whether you receive loan forgiveness for some or all of the loan that you receive. Another big piece of the new rule is what happens if the PPP loan funds are misused. With some of the shortcuts that the lenders are allowed to make in order to get these loans out expeditiously, they're not going through the same background check, credit check, et cetera, process that they would normally go through. They're not getting, personal guarantees, that sort of thing. There's a little bit more reliance on the honor system here. And the regulations stress that if the PPP loan funds are misused, if they're used for things that are outside of the allowable purpose of the loan, the SBA will, at a minimum, require repayment. And a borrower who knowingly uses the funds for unauthorized purposes will be subjected to additional liabilities, such as charges for fraud. So the SBA has made it pretty clear that they've got some enforcement authority here. And there might even be criminal consequences of deliberately misusing SBA funds, PPP funds. The SBA regulations provided some additional guidance or some additional rules on how the EIDL loan program, this is the disaster relief loans, coincide with the PPP program. If you received an EIDL loan from January 31st through April 3rd of 2020, you can still apply for a PPP loan. If the EIDL loan was used for payroll costs, the PPP loan must be used to refinance that EIDL loan. And the amount of the EIDL loan that was used for payroll costs counts towards the percentage of proceeds used toward payroll when you're looking at the 75 to 25% ratio that we discussed. Also, any proceeds from an EIDL advance, which are up to $10,000, will be deducted from the loan forgiveness amount on the PPP loan. Remember, under the EIDL grant program that the CARES Act created, a borrower could request an advance of up to $10,000 that would be payable immediately according to the statute and was not subject to repayment. That was designed essentially to help bridge the gap between the economic effects, the immediate economic effects of COVID-19 and the availability of other loan proceeds, for example, under the PPP loan process. Unfortunately, the EIDL loan process has been, like PPP, subject to a lot of difficulties. I believe most borrowers who applied for an EIDL advance have not yet seen the cash advance that was promised. Or received confirmation or much communication at all about the EIDL grant process. And those who have received the up to $10,000 advance, many of them have not gotten the amount of the advance that they initially requested or were expected. But in any event, the PPP rules from the SBA do provide some information about how the EIDL program and the PPP program work together. There was some initial concern when the CARES Act came out that it was an either-or proposition. You can't get an EIDL grant and a PPP loan, but the rules make clear that you can. In addition to the official rules, the official regulations that came out from the SBA, there's also been some ongoing guidance that's provided on the SBA website in the form of frequently asked questions or FAQs on PPP loans. This, again, is not as official of a requirement as the regulations or the rules are, but they do provide us with exactly what they're intended to provide us with, some really good guidance about how the SBA reviews the loan processes. These FAQs are numbered, beginning with 1. I'm not sure what number they're up to now because they're updated very frequently. So if you haven't already checked out the SBA website and looked at the frequently asked questions, that's a really good source of information on a variety of topics. We'll cover some of the big ones here, but you'll see that there are a lot more that are available, and they're updated all the time. So I'd encourage you to look at the SBA website, check out the frequently asked questions, and have you or whoever's responsible for overseeing or administering your PPP loan process, check back regularly to see what additional guidance might be available. One of the big areas where the frequently asked questions have provided guidance is in the definition of payroll costs. And the definition of payroll cost comes into play in a few different ways with the PPP process. One is that, of course, we're using average payroll costs over a 2.5-month period we're using 2.5 times the average payroll cost over the previous 12-month period, which is designed to get us about 2.5 months of payroll. We're using that as a basis for determining the maximum loan amount. We're also using payroll costs and the amount that we spend during the 8-week period after the loan proceeds are dispersed to determine the amount of the PPP loan that might be forgivable. So the payroll costs come into play in a couple of different ways here. The frequently asked questions from the SBA make clear that the payroll cost should be computed on a gross basis without regard to federal taxes that are imposed or withheld. This is a little bit different, and the frequently asked questions acknowledge this, than what's contained in the CARES Act. There was some real confusion after the CARES Act was enacted about, well, what do we do about all these federal deductions for income taxes or for FICA, for example? And the FAQs make clear that payroll costs should be computed on a gross basis without regard to reductions or withholdings for federal taxes. But the employer share of payroll taxes are still excluded from the definition of payroll costs. And I encourage you to take a close look at that frequently asked question if that's an issue that you're dealing with. The guidance in the frequently asked questions also make clear that the definition of payroll costs includes the costs for employee vacation, parental, family, medical, and sick leave, except remember qualified leave for which a borrower might be entitled to payroll credit under the Families First Act. should not be included in payroll costs. The family's first paid leave costs should be excluded. The facts make clear that the payments to independent contractors or sole proprietors should not be included in payroll costs. And also, when we exclude compensation in excess of $100,000 for an employee's annual salary, that applies only to cash compensation and not to non-cash benefits, such as premium payments for insurance, for group health coverage, for example, or contributions to defined benefit plans. So that exclusion of compensation in excess of $100,000 salary applies only to cash. The frequently asked questions also make clear that the borrower can use the average amount of payroll costs for the previous 12 months before the loan application or the calendar year 2019 to determine the maximum loan amount. And there are some special rules that are addressed in the frequently asked questions that apply to seasonal businesses or to applicants who are not in business during the February 15th through June 30, 2019 period. Some additional highlights from the frequently asked questions. These frequently asked questions and the guidance is changing all the time, sometimes on a daily basis, right? So the SBA addressed that and made clear that both borrowers and lenders are entitled to rely on the laws, rules, and guidance that were available at the time of a previous loan application. So, we don't have to have crystal balls. We can rely on the guidance that's available to us at the time. And if there are changes, we shouldn't be held accountable for that. There is one very significant piece of the frequently asked questions that I wanted to highlight here, and that just came out last week. Y'all have probably heard, and I live in North Carolina, so my use of y'all is displaying my geography here. But y'all have probably heard that there have been some very large publicly held companies that have gotten funding through the PPP. And that funding was appropriate based on the language in the CARES Act that allowed, for example, in the restaurant or hospitality industry, the 500 employee limitation to be applied on a per location or per facility basis as opposed to an overall limitation. But many of those larger companies, as you've probably seen in the news, have voluntarily returned the funds to the PPP, to the government, for hopefully further folding into the PPP amount that's available for other borrowers. And they didn't just do that out of the goodness of their heart, although I'm sure many of them did have the best interest of the country and the small businesses in our country in mind. The PPP, if you remember, requires all borrowers to certify under oath that current economic uncertainty makes the loan request necessary to support the ongoing operations of the applicant. And this certification has to be made in good faith. And the recent guidance that has come down from the SBA says that it has to be made taking into account current business activity and accesses to other sources of liquidity. The SBA says in its guidance it's very unlikely that a public company with substantial market value and access to capital markets will be able to make a certification in good faith and should be prepared to demonstrate to the SBA upon request the basis for that certification. The guidance also says that if you applied for an SBA loan before April 23rd, which was when this new guidance was issued, and you repay the loan in full by May 7th, you will be deemed by the SBA to have been made the required certification in good faith. So the SBA has done a few things here. They've made it clear before this new appropriation of funds came about that they take this certification seriously. And you really need to be able to show as a borrower, an applicant, that you've got a current economic uncertainty that makes a loan necessary. And you'll see when we get into some of the practical suggestions and guidance for borrowers that we've got some recommendations for how to be sure you can back up and document that certification in case the SBA comes behind and never wants to see anything about that. So I do hope that this guidance and some of the recent media coverage of the funding going to some pretty large publicly held companies will help this new transfer of funds be available primarily for the small business community that was intended for. The SBA has issued a separate set of frequently asked questions about how to calculate maximum loan amounts. And I won't go into this in a lot of detail because it's very technical and some of this might not apply to everybody who's on the line today. But the new frequently asked questions break down by type of business entity how the maximum loan amount should be determined. It does this separately for self-employed individuals with no employees, for people who are self-employed and have employees, for partnerships, for S Corps, and for C Corps. And then for LLC owners, the guidance says that LLC owners should follow the instructions relating to their tax filing situations. For example, if they file as a sole proprietor, those are the instructions they should follow. The same for if they file as a partnership or if they file as a corporation. This is very helpful information. I encourage you to take a look at it. And even if you've already gone through the lending process and determined your maximum loan amount, this frequently asked question might also be helpful in helping you to determine how to determine or identify the forgivable loan amount, the forgivable amount of the loan that you might have. So let's talk about that. That's one of the biggest questions from both applicants and people who've already received the money is, okay, I've got this money, I've been given this opportunity. How much of my loan will be forgiven? How can I make sure that I use the funds as they're intended to be used, and that to the extent possible, I take advantage of the forgivable nature of these loans, which essentially transform the forgivable amount of the loan into a grant that doesn't have to be repaid. So how much of my loan will be forgiven? Up to the full principal amount of the loan, and any accrued interest can be forgiven if the requirements are met. Now, these next few slides are taken both from frequently asked questions that are posted on the Department of Treasury and IRS page, and also from the SBA guidance and rule. So when you're taking a look at this, remember it's not just the SBA, it's the Department of Treasury and the IRS who are also involved in determining how some of these provisions will work together. So this language is from the IRS website. You will owe money when your loan is due. If you use a loan amount for anything other than payroll costs is defined by the law, mortgage interest, rent, and utilities payments over the 8-week period after the first disbursement of loan proceeds. So the 8-week period for purposes of the forgivable portion of the loan is measured after the first disbursement of the loan proceeds. Not more than 25% of the forgiven amount may be used for non-payroll costs. And again, this is in order to effectuate the statute's intent of encouraging and helping small businesses keep people on the payroll. And any idle advance that you receive, that up to $10,000 amount will be deducted from the forgiveness amount. You will also owe money if you do not maintain your staff and payroll. And there are some very detailed, somewhat convoluted formulas in a statute that we've covered in past webinars. But the short story is your loan forgiveness will be reduced if you decrease your full-time employee headcount from the levels that you had on February 15, 2020, or if you decrease salaries and wages by more than 25% for any employee that made less than $100,000 annualized in 2019. And there is I call it a safe harbor or kind of a grace period for rehiring. You have until June 30, 2020 to restore your full-time employment and salary levels for changes or reductions that were made, either in headcount of full-time employees or the level of payroll of more than 25% for any employee, as long as those changes were made between February 15th and April 26, 2020. So of course, we've already passed that April 26th date now, but if you had to let someone go or reduce payroll by more than 25% for an employee before April 26th, the law gives you until June 30th to restore full-time employment and salary levels to the February 15th level. And that will prevent your loan forgiveness from being reduced at all. How can I request loan forgiveness? It's important to remember that even though there are parameters set out for loan forgiveness under the statute, it's not automatic. The statute provides that you have to apply to your lender in order and submit certain documentation in order to receive loan forgiveness. The law provides that your lender is supposed to determine with you an expected loan forgiveness amount. And then once you submit a request to the lender that's servicing the loan with the required documentation, the lender must make a decision on loan forgiveness within 60 days after you submit that request. So let's break that down. How can I request loan forgiveness? You can submit a request to the lender that's servicing the loan, and you'll need to submit documentation. And that should include documents that verify the number of FTE, full-time equivalent employees on payroll and pay rates for relevant time periods. And that can include the payroll tax filings that you report to the IRS, along with any state income, payroll, and unemployment insurance filings. And then for the non-payroll uses of the loan proceeds, non-payroll costs, you'll need to include documentation that might be canceled checks, payment receipts, transcripts of accounts, or other documents that verify payments that were made on coverage mortgage interest payments, lease obligations, and utility payments. You'll be required to certify to the lender that the documents are true and that you use the forgiveness amount to keep employees and make eligible mortgage interest, rent, and utility payments. And again, a lender is supposed to make the decision on the forgiveness within 60 days. What terms apply to any loan amount that's not forgiven? Now, if there is any portion or even if all of your loan proceeds are not forgiven, the principal amount of the PPP loan and any accrued interest that's not forgiven will continue as a loan on its original terms. That includes a maturity date of 2 years from the disbursement of the loan proceeds. The payments on the loan will be deferred for 6 months, although the interest still does accrue during that 6-month deferral period. And the interest rate that's set for these loans is 1%. This is important. There's no prepayment penalty. These loans might be made available on the secondary market, so there might be a prior notice of prepayment required if your loan has been sold on the secondary market. So if you receive a notice that your loan's been sold, pay attention to that. But there's no prepayment penalty, so there's some flexibility here where if your payroll needs change in some way and you don't get the amount of loan forgiveness that you expect, as long as you don't spend that money on something else, you can go ahead and prepay that without any penalty before incurring a significant interest on it. Okay, I'm going to give you a disclaimer first. How will PPP loan forgiveness be treated for tax purposes? Here's my disclaimer. I'm not a tax lawyer. I'm primarily a labor and employment lawyer. But I did want to alert you to this because it's significant. There's been all kinds of debate among tax professionals about the CARES Act PPP provisions. Here's what we know. The CARES Act provides two things. One is that the forgiven amount of a PPP loan will be considered a canceled indebtedness, and ordinarily that would be taxable income. Under federal law, the Internal Revenue Code, loan forgiveness generally counts as taxable income. But the CARES Act also provides that for purposes of the Internal Revenue Code, any amount that but for the subsection would be normally included in a borrower's gross income by reason of forgiveness shall be excluded from gross income. So that's another way of saying that even though the forgiven amount of a PPP loan will be considered canceled indebtedness, for purposes of federal income tax, any amount that's forgiven should be excluded from gross income. Okay, so in other words, it's not taxable as gross income, the forgiveness amount. One thing that is not clear is how state tax treatment of the loan forgiveness will be handled. And that's going to depend on the state law, your own state law where you file taxes. The state tax treatment of loan forgiveness might end up varying depending on whether your state laws automatically incorporate provisions that bring the tax codes into conformity with the federal IRC, or Internal Revenue Code. And here's what that means. State tax laws generally either adopt a rolling conformity standard or a static conformity standard. What that means is that they generally conform to the federal Internal Revenue Code. Some states have a rolling conformity standard. And if you're filing taxes in one of those states, you should be in good shape as far as the CARES Act is concerned, because that means on a rolling basis, the state tax law brings itself automatically into conformity with federal law. In states like North Carolina, where I'm located, that have static conformity incorporated into their state tax codes, that's a different story. What that means is that the state tax code conforms to federal law, but there has to be an act, and usually it's an act of the state legislature. Some states notoriously lag behind on their conformity dates. They're not good about bringing about a legislative act that brings a state law into conformity with federal tax law every single year. Others are running behind this year because of early adjournment due to the COVID-19 crisis. So I would talk with your tax professionals, be sure you understand how the loan forgiveness is going to be treated under your state tax laws. Hopefully the states will be good about, especially given the CARES Act provisions, bringing their own laws into conformity with the federal law and with the CARES Act, so that the loan forgiveness is not treated as taxable income under your state law. But that's something that the tax professionals are watching closely, and I want to be sure you're watching it closely as well. Now, we've talked about some of the answers that we've received and already covered some of the questions that remain unanswered. I want to touch upon a number of what I consider to be pretty darn big questions about PPP loans that remain unanswered at this point. And as I've said, the SBA and the Department of Treasury and IRS have been good about issuing guidance in the form of these frequently asked questions. Hopefully they'll continue that process. We're also still expecting some formal rules, some additional formal regulations, or at least some more guidance on the loan forgiveness process. And I'll cover that in just a second. Here's one big question. Will the 8-week period be modified or extended to account for businesses who've been closed due to stay-at-home orders or for other reasons relating to the COVID-19 pandemic? Remember, that 8-week period is the 8 weeks during which your allowable or forgivable costs, 75% or more of which must be payroll, 25% or less would be your mortgage interest obligations, your rent or your lease obligations, and other forgivable expenses. That's the 8-week period we're talking about there. So there's been some discussion and some question about whether Congress or the SBA might allow that 8-week period to be changed for businesses that have been affected by stay-at-home orders, or modified in some way so that you can maximize the forgivable loan amount. If you're not able to have people working and you're not incurring payroll costs during the 8-week period, it's really difficult to, meet the level that's required to get, a substantial portion of your loan forgiven. So that's one remaining question that's out there, and it's a frequently asked question among our clients. Another question is, what does the phrase costs incurred and payments made mean? The loan forgiveness section of the CARES Act says that the costs incurred and payments made for payroll or for the mortgage interest obligations or rent or lease obligations, for example, that are incurred and payments made during the 8-week period are eligible for loan forgiveness. And there's been all kinds of debate about what that means. And this is especially significant when it comes to the payroll portion, I believe. So the question is, must a cost be both incurred and paid during the 8-week period in order to be eligible for loan forgiveness? Or are costs still eligible for forgiveness if they're either incurred before and paid during the covered period, or incurred during and paid after the covered period? And you can really imagine how this might come up in the payroll context, right? When we're looking at what payroll costs are potentially forgiven, are we talking about the payroll payments that are actually made on our regularly scheduled paydays? Are we talking about the costs incurred, the payroll costs that are incurred? How do we measure that? It's the first version of the definition, a cost must be both incurred and paid during the 8-week period, is the one that applies. Obviously, that's a much narrower definition and would encompass a much smaller amount than the second definition, where basically, and this would be the broader definition, the cost could either be incurred or payments made during that 8-week period. I believe if we look back at the intent of the CARES Act of basically expeditiously helping small businesses, I believe that the more generous definition should apply if I were running the world, which means that we could choose between whether the costs were incurred or the payments were made during that 8-week period in order to determine what's potentially forgivable. That's going to be most generous towards employers, and it's also going to more accurately reflect what amounts to an 8-week payroll period, which is something that the Act was clearly designed to try to help small businesses meet. So keep an eye on that space. That's something that's important and it's not yet answered. Another outstanding question that I'd like to see an answer to from the SBA is, how is rent defined? Payments made toward rent on a lease agreement that was in place, on or before February 15th, 2020, are eligible for forgiveness. At least to the extent they're less than 25% of the total forgivable amount. Does this include common area maintenance or other fees that are included in some lease arrangements that borrowers might have? And is rent even limited to the lease of real property? Rent is not defined yet, either in the CARES Act or in the SBA rule or guidance. Some more unanswered questions. And I'm waiting for the point where I can tell you that my list of answered questions is longer than my list of unanswered questions about the PPP. What is a full-time equivalent employee? That definition of full-time equivalent employee would be very significant in terms of determining whether we retained our payroll as required to meet the loan forgiveness requirements, or whether we fully restored our payroll before June 30th in order to maximize loan forgiveness. How will furloughed employees be treated? Temporary furloughs. How about employees on reduced schedule, if it's a temporary reduced schedule necessitated by the pandemic? Employees who are on paid leave, or employees who have either voluntarily resigned during the relevant periods or who refuse to come back to work. These are all unanswered questions at this point. And given the relative generosity of the special unemployment benefits that are available to people who've lost their jobs or had significant reductions in their hours or their pay relating to the pandemic, that's a real concern that a lot of borrowers have. Will people want to come back to work, or would they rather see if they can stay out of work and potentially try to recover these enhanced unemployment benefits? Maybe they've got other reasons for not wanting to come back to work. Again, I believe that under most state laws, recovering the enhanced unemployment benefits after you've been asked to return to work and you've got work available for you would be problematic. But most states are really scrambling to keep up with the volume and the new requirements of the enhanced unemployment benefits. And I do imagine a lot of the people who would otherwise be caught up, be targeted as someone who's refused available work might slip through the cracks. Here's another tax question. Again, I'm not a tax lawyer, but something that's still open is whether a PPP borrower may deduct from taxable income the business expenses that were funded by the forgiven loan. So if you've used your PPP loan as it's intended for business-related purposes, and some or all of the principal of your loan has been forgiven, can you still also make deductions from your taxable income for those business expenses? Again, if I were in charge of the world, I would argue that you should, as a borrower, still be entitled to deduct those expenses. Otherwise, there's no real net gain to you as a borrower under the PPP program. You might receive forgiveness for the loan amount, but you lose the benefit of the tax deductions. And to me, that's not an overall substantial gain for borrowers. So if I were in charge of the world, I would say, yes, they're still should be deductible, those business expenses, even if they've been part of the forgivable amount of the loan. But I'm not in charge of the world, unfortunately, and we'll see how the IRS and Department of Treasury guidance comes down on this. Finally, the CARES Act stated that no later than 30 days after its enactment, and I remember the enactment date because it was my husband's birthday, March 27th, the SBA was required to provide guidance and regulations regarding the loan forgiveness provisions of the PPP. That 30-day period passed on April 26th, this last Sunday, and I was really hoping that we were going to see some additional regulations or at least guidance on the loan forgiveness piece before we had our webinar today, but alas, it has not yet been published. The interim final rule that was issued in mid-April by the SBA reiterated that additional guidance on loan forgiveness will be forthcoming. And so that's one of my big and burning questions is, will the further guidance be provided? And if so, when? I mean, we're now into our second tranche of appropriations for this program, and there's still some real questions about how one of the key features of the PPP, the forgivable loan features, will be interpreted. But in the meantime, we are prepared to offer some suggestions for best practices for borrowers. And first of all, this is key for all of you, whether you've already applied for and received your PPP funds, whether you're in the process of applying, or whether you're in line waiting to get approved. Be sure you carefully review all of the required certifications under the PPP and ensure that each element passes the good faith standard. The SBA, in issuing this recent guidance on April 23rd, has made clear that even though they're banking on the honor system in a lot of ways, they reserve the right to come back and request further information about the basis of your certification. So we don't yet know how extensive those enforcement activities will be, and what kind of audits you might be subject to. But I would focus on how the current economic uncertainty makes the loan requests that you're making necessary to support your ongoing operations, and consider your current business activity, consider your access to other liquidity, and document your good faith basis for making each of the required certifications. That way, if you're ever audited, or if the SBA ever comes back and asks, about the basis for your certifications, you'll be in good shape. It'll also help you determine whether you feel good about those certifications. I mean, a lot's changed on a weekly basis, sometimes on a daily basis with the current economy. And it may be that when you initially applied for the loan, back when the funds were first available, you had some real concerns and a basis for your uncertainty about the economic situation, and a basis for believing that the economic uncertainty made the loan request necessary. And perhaps that's changed by now. If you don't feel good about the certifications that you made, you can always consider returning the funds by May 8th if the circumstances no longer justify it. And that way you're free and clear as far as the SBA is concerned. I don't imagine that many of you on the call will be, or on the webinar today, will be subject to this. This is primarily something I think that will affect some of the publicly held companies, the larger companies that receive the loans. But again, the fact that the SBA is focused on this is a good reason for us to focus on it as well, and make sure that our certifications are substantiated. Keep detailed records documenting your use of PPP proceeds beginning on day one of that 8-week covered period. And remember that your 8-week covered period begins on the day the first funds are dispersed. I would insist upon receipts and documentation for allowable uses, whether that's a payment under a lease agreement or mortgage interest payment or any other allowable use, and create an organized system to store your documents. And I'd also create a separate electronic tracking system, or even a handwritten tracking system, or type tracking. Any kind of tracking system is fine to record your use of PPP proceeds. And this is in addition to the records that you'll be keeping in your file. And this would allow you to track your payroll or other costs based on both the costs incurred and the costs paid methods until we see which way the statutory language will be interpreted. And communicate with your lender about all of these things, and be sure you understand at a minimum what your expected loan forgiveness amount is, because the statute does provide that your lender is supposed to make that determination, and also the process for applying for loan forgiveness. What documents will they require? Will there be an application that you need to fill out? What's their process for that, and what's their time frame for that? Because there'll be some variances among the commercial lenders in how they treat this. Consider depositing the PPP loan proceeds in a separate bank account so that you can keep those funds separate and perhaps transfer them to your payroll account as needed to get your payroll out. And that's a really good way and a safe way of tracking how you've used the funds and the amount of the funds that are used, to make sure it's not intermingled with your other operational funds. And be mindful of the allowable uses of the PPP loan proceeds, even if you don't intend to seek full or partial loan forgiveness. And I say that because the CARES Act provides for a very specific list of allowable uses of PPP loan proceeds. And some of the sections of the rule that we discussed, the SBA's rule, talks about how those allowable uses apply. And even if we're not seeking loan forgiveness, how the 75 to 25% ratio might apply even to how you use the loan proceeds. So even if you don't intend to take advantage of the loan forgiveness aspects of the PPP, still be mindful of how those loans are permitted to be used. And pay attention to further guidance on whether that 75%, more than 75%, no more than 25% may be used on no non-payroll expenses, and at least 75% has to be used on payroll. A lot of companies and borrowers are designating specific people, specific employees who will be responsible for tracking and documenting the use of PPP proceeds. For many of you on this call, that's likely to be you. But make sure that the designated personnel are properly trained on the CARES Act and lender requirements for PPP loans, that they know that they should, pay attention to the IRS and Department of Treasury guidance, as well as the SBA guidance that's coming out on an ongoing basis, and continue to stay on top of all the regulatory information that's available for us. Make sure you consult with your accountants and your tax advisors on the PPP implications, and that would include the specific questions that we raised on today's webinar. One of those is how state tax law might impact any forgiven amount of the loan in terms of whether it's considered taxable income. And another is whether the business expenses that you use your PPP loan proceeds to pay that might end up being forgiven may also be used, declared as deductible business expenses for purposes of state and federal income tax. So make sure you talk with your tax advisors about how those impact your particular situation. And then finally, stay tuned. Continue to watch this space and look for additional guidance coming from both the SBA and the IRS, and hopefully very soon some additional guidance on the loan forgiveness piece of the PPP. And with that, Mike, do we have any questions?
So Jill, we do. We have quite a few questions to dive into, and we'll go through the most frequently asked and most popular ones of those. Before we do that, thank you so much for the wonderful content. I think a lot of questions answered already, and for the questions that have been submitted that have been answered there, we'll skip over those. I know some were asked before you had gotten to the answer, so we'll dive into what we do have. So, Jill, our first question: if you're forced to be closed by the government, does that have any impact on the starting the clock on that 8-week covered window, or does that absolutely start the day your loan is funded?
The answer right now, as of the guidance that's currently available and the current SBA rule, is that that 8-week period absolutely starts on the day that the funds are dispersed. And that even if your business is forced to be closed by the government because you've been deemed non-essential or, for any other reason under a local or a state order, your 8-week period still starts on the day the funds are dispersed. And at this point, there's no flexibility that I've heard of among any of the lenders and borrowers being able to specify when their loan proceeds will be dispersed, or otherwise modify or adjust that 8-week period. But again, that's something that's been discussed quite a bit among professionals who follow the CARES Act and the PPP program. And it's something that's on the table. It's an open question that I hope the SBA will address. And I'm hoping that that will come out in the form of an actual rule or a regulation, which carries, as I said, a greater force of law than simply guidance. So I'm really hoping that when we get first of all, that we will get some additional rules and regulations from the SBA about the loan forgiveness piece as promised, and also that those rules and regulations will address that 8-week question, because so many small businesses around the country are impacted right now by these orders, and depending on where you're located, will continue to be impacted by these orders. And for those of you who've already received your funding, that clock's already ticking. So I really hope we get a definitive answer on that, and I really hope there's going to be some flexibility. Otherwise, it doesn't seem to be providing the small businesses the relief that the CARES Act and the PPP program were designed to provide.
Right, and a related question there too, just for additional clarity. The question was asked, does the 8-week period begin on the first distribution of funds to the borrower or the first distribution of funds by the borrower?
To the borrower.
Okay.
So when you first receive the disbursement of the funds is when your 8-week period begins.
Okay. Our next question, this one's been asked in a couple different forms. Is there any limit to what portion of the PPP funds could go to the business owner? Since everything was based on 2019 payroll disbursement, it would seem that the owner should be able to pay themselves the salary they had previously received. Do you anticipate any issues from an owner continuing to draw their salary?
I would take a look at the frequently asked questions from the SBA that specifically deal with how maximum loan amount should be determined for all different types of business arrangements. Under most situations, if the business owner receives a salary and it's treated as a salary for tax purposes, then that amount, I believe, should be an allowable use and a forgivable use of PPP loan proceeds. So I would take a look at those frequently asked questions and at how your business is set up. Are you a sole proprietorship without employees, with employees, and what type of a business are you? And that will provide some good information about the income that goes to owners that may be treated as both a part of payroll costs for purposes of determining the maximum loan amount and also for purposes of the allowable uses and the forgivable amount. But the short answer is, in most cases, I believe that the salary that's paid to a business owner, if it's treated for tax purposes as a salary, and not an advance or some other type of arrangement should be an allowable and forgivable use.
Okay. This one's pretty simple, but worth talking about. The PPP funds, once those have been received, can they be held in an interest-bearing account?
I hope so. I haven't seen anything that indicates to the contrary. Let me put it that way. There's no limitation on how you hold those funds. You need to put them in an account of some type, and I wouldn't see any limitation on putting them in an interest-bearing account. I don't know that I'd put them in a, invest them in a stock market or anything, especially right now. You'd certainly want to put it in an account that's going to remain available and liquid for the immediate future, because the whole intent of these funds is to use them right away. And that's certainly the case if you're going to capitalize on the forgivable loan aspect of the program. But I don't know of any limitation that would prevent you from putting these these funds in an interest-bearing account.
Perfect. Thank you for that answer. Our next question, even though I have until June 30th to bring back my team and restore their wages, if my 8-week covered period is already open, wouldn't waiting that long likely have a big impact on the amount of loan proceeds that I'd be able to spend while covered and considered for forgiveness?
Yes. Yes. And the reason for that is, remember, there's 2 different covered periods in the CARES Act. There's this idea that the CARES Act and the PPP program is supposed to generally cover this period through June 30th, which is, I guess the initial estimate that Congress made as to how long this immediate economic impact of COVID-19 would be with us. And then there's this 8-week period during which your eligible costs or qualifying costs are forgivable. The amount of those costs are forgivable. And 75% of it at least has to be attributed to payroll costs in order to be forgivable. So if you've had to let people go due to the pandemic, and you've already gotten your PPP loan disbursement, your 8-week period's already running, there's a very limited amount of that you can be spending on payroll costs right now, and that's going to really hurt your loan forgiveness amount, the amount that you're able to get forgiven through this. So to really maximize the loan forgiveness amount, you would bring back or restore the salaries or the FTE headcount as quickly as you can after that 8-week period starts, so that you can use the required amount of your PPP loan proceeds for payroll costs and maximize your loan forgiveness. As long as you bring people back by June 30th, your overall loan forgiveness amount won't be reduced, but the overall loan forgiveness amount will be much lower if your payroll costs are lower during that 8-week period. Does that make sense?
Absolutely. Very easy to understand, and thank you for that clarification. On our next question, I've had employees refuse to come back as they're making more money on unemployment and simply don't believe me that they'll lose those benefits after refusing to come back to work. However, once an employee has refused to return to work, can I replace them with new employees and still be considered for forgiveness under PPP?
This is a problem that's come up time and time again, and a question that's come up time and time again. My belief is that based on my reading of the CARES Act, as long as you get your full-time equivalent employee headcount, your average number of full-time equivalent employees back by June 30th to the same level it was previously, your regular, your February 15th level, then it doesn't matter who is holding those positions. In other words, I believe, based on my reading of the CARES Act, that as long as you've got the same headcount, number of full-time equivalent employees, then your overall loan forgiveness amount should not be reduced. In other words, you don't have to bring back the exact same people. My hesitation about this is that the section of the CARES Act that deals with the reduction in loan forgiveness based on the reduction in the number of full-time equivalent employees or the reduction in any one employee's salary of more than 25%. The section of the CARES Act that deals with that is entitled, and I'm flipping to it now, it uses the word rehire in the title of it, which is different than simply restoring the FTE, number of FTE. But the actual language of the statute, not the title of the provision, talks about it in terms of restoring the number of full-time equivalent employees.
Right.
So my belief is that if you get your numbers back to the same level they were on February 15th, that you should be in good shape in terms of loan forgiveness. Again, I'm not the final authority on this, unfortunately. So, keep an eye on that in terms of the ongoing SBA guidance, and I really hope we get that loan forgiveness guidance and regulation soon. But that's my read of it. That's my belief of what the statute's intent is.
Thoroughly understood there. Now, here's one that's come up in several different wordings, Jill. As the business owner, is my personal wealth considered access to liquidity for my business?
That's a really good question. I do not believe so. I believe when the SBA came out with this additional guidance last week about considering what personal liquidity or what liquidity is available for a small business and determining whether the PPP loan is needed, given the current economic uncertainty, they were looking really at publicly held businesses and businesses that had access to all different types of lending vehicles and funding through the marketplace. So I do not believe that an owner's personal assets or personal wealth should be a factor in making that certification.
All right, we'll hope that holds to be the case. On a related note, my business is open as essential. Business has, of course, been down, but we are still barely profitable. Does this mean that I need to give back my PPP proceeds?
Will you repeat that question again for me, please?
So my business has remained open as an essential business. Business has been down, but we're still just barely profitable. Does that mean I need to give back my PPP proceeds?
The question that the SBA will be looking at is whether the uncertainty of the pandemic creates. Now I'm flipping back so I can cite the exact language as we're looking at this. Basically creates a concern about the ongoing operation of the business. Bear with me, I'm flipping. I want to look at the exact language.
Certain.
I think that a diminished revenue would not likely be a situation where the economic uncertainty makes the loan request necessary to support the ongoing operations of the business. In other words, if you think about what would happen if you didn't get these loan proceeds, or if you hadn't gotten the loan proceeds, the question is really, would we be able to continue operating? Would there be substantial reason for concern about whether our business can continue operating? And if you're just looking at a reduced revenue situation and there's no additional concerns out there, I'd have a real question about that. I'd suggest that maybe you talk with somebody who's got a good understanding of your overall economic situation, whether that's your accountant, maybe your tax advisor, and there may be some factors relating to your business that would even under these circumstances justify a certification that current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. But I would have some concerns about making that certification and continuing to stick by that certification, given this brand new guidance that came out. If what we're seeing is simply a decreased profit. In other words, if we don't have any concerns about our ability to pay our operational expenses without the PPP loan proceeds.
Certainly something to look into a little deeper on an individual basis. So our next question should be a fairly simple one, I believe. When we're funded with our PPP, we can't also use the FFCRA payroll credits in addition. What about when the 8-week period is done? Would we be able to then use the FFCRA credits after our 8-week window was closed?
Okay, there's been a lot of discussion about how the Families First Act payroll credits and the PPP process work together. And they're really two separate processes. The CARES Act provides that any paid leave that is provided to employees under the Temporary Families First Act, people who are out of work for various reasons that are related to COVID-19. If it's qualifying Families First leave, we're entitled to apply as businesses for immediate credits against our payroll taxes for the amount of the expenses related to this paid leave. So that means that the federal government essentially reimburses us for the expenses that we're incurring as employers for providing this paid leave that's required by the Families First Act. And that's through immediate tax credits, the payroll taxes that we pay. The PPP is completely separate, and the PPP provisions of the CARES Act provide that any qualifying Families First leave for which we're entitled to get payroll tax credit should not be counted as payroll costs, either for purposes of determining the overall amount of the loan or for determining loan forgiveness or allowable uses of the loan. And that's really designed to keep us from double dipping. In other words, we can't get a forgivable loan to pay for the paid leave that's required by Families First, and also at the same time get an immediate reduction or even a reimbursement in our payroll taxes that we owe the federal government, because essentially we'd be getting payment from the federal government for the same purpose twice.
Right.
But there's nothing about the PPP loan process that prevents you from accessing that payroll tax credit that's available for Families First paid leave. I think that there's been some confusion about this because in the CARES Act, and it's very understandable confusion, in the CARES Act, there's a completely separate provision that allows for payroll tax credits for companies that are substantially impacted and their revenues are substantially impacted by the pandemic. And those payroll tax credits that are included in the CARES Act are completely separate from the payroll tax credits that are addressed in the Families First. And under the CARES Act, if you get a PPP loan, you're not entitled to also take advantage of the payroll tax credit program that's available under the CARES Act. You either have to do one or the other. And I think because both the Families First paid leave provisions relate to payroll tax credits of a different type, and because there's a separate payroll tax credit benefit that's available in the CARES Act as an alternative to the payroll protection program, or Paycheck Protection Program loans, I think there's been some confusion. So the short answer with that long explanation is that as a PPP borrower, you can and should still take advantage of the payroll tax credits that are available for the costs associated with providing paid leave under the Families First Act. And the way to do that, there's a really good page on the IRS website that outlines the way to do that and has a number of frequently asked questions there. And that the frequently asked questions actually address this very question because this confusion has been so prevalent. Yes, you can still take advantage of those payroll tax credits for paid sick leave or paid expanded family medical leave under the Families First Act, and at the same time get a PPP loan. You just can't count the amount that you get a payroll tax credit for under Families First towards your payroll costs. Does that answer the question?
It does. Answers it very well and very thoroughly. This one should be a very simple answer. If you've already applied or been approved for a payroll protection program loan, but you had not applied for the EIDL and you're able to get the application in now, can you make that application?
I believe the answer to that is yes. And the reason I qualify that a little bit is because the SBA rules that came out regarding the PPP loan talk about idle advances or idle loans that are made between January 31st and April 3rd, the date on which PPP loans first became available. But yes, I believe you can still get an idle loan. If I were you, since you've already got the PPP funding, I would not designate as a purpose for your idle loan payroll costs. I designate other purposes for your idle loan, and that way it's clear that you're not, as a PPP borrower, receiving a second source of funding for your payroll costs. In other words, for the same costs that the PPP loan is designed to cover. And that'll also prevent you from having to, either refinance your idle loan within your PPP loan or deduct your loan forgiveness amount by the amount of payroll costs that the idle loan covers. The PPP loan certification in the application process does require a borrower to certify that they haven't sought or received additional funding from another source for the same costs that they are seeking to fund through the PPP program. And especially now, given this new 75 to 25% ratios, making it really clear that the PPP loans are supposed to be used very much primarily for payroll costs, I'd keep that focus of the PPP loans on the payroll costs, and any new idle loan request I'd make for other purposes outside of payroll.
Absolutely. Totally understandable there. If an employer uses a PEO, such as ADP, will the payroll costs cover the fees that the PEO charges to administer the payroll?
Oh, that's a really good question. And there is a frequently asked question on the SBA website that deals with the use of a PEO. I don't know, just based on my memory, whether it addresses that specific question, but I would point you there to see if that frequently asked question on the SBA website about the PPP program deals with whether PEO fees are included as a part of payroll costs. I don't know the answer to that question off the top of my head.
Going for us to research, and we'll put that on the notes to take away from the call. Now, here's another one very similar. Do payroll costs include payments to SEP retirement plans for employees?
Bear with me one second, please. I should be able to answer that one pretty quickly.
And while Jill looks that up, I will go ahead and tell you we have more questions already in, and we're going to be able to get answered before the call ends here in about 6 minutes. However, our answers portal is still available for you. If you have a question, you're welcome to send that to ask@nationwidegroup.org. You're welcome to send those in, and we will be happy to do our best, working with our outside experts like Jill, to get you an answer to those. You're welcome to send those in. It's ask@nationwidegroup.org.
Thank you for buying me a little bit of time there, Mike. The payroll costs are defined pretty broadly in the PPP provisions, and they do include the cost of paying retirement benefits. So I believe the answer is yes, but let's add that one to our further research questions, just so that I can confirm that those specific types of contributions should be covered.
Absolutely. A question here. If all the funds haven't been used by the end of the 8-week period, once that transitions into a loan, does it then still fall under those guidelines from the CARES Act of how those can be used? Must that still be tracked? Or once it becomes just a loan with no forgiveness, can that be used for all operating expenses?
That's a super good question, and it's one that we've discussed and looked into in some detail. The way that the SBA's final rule, the interim final rule reads, is that even regardless of whether the loan is forgiven either in whole or in part, the loan proceeds should still be used only for the allowable purposes under the Act, and that the 75% to 25% ratio should still apply to those loan proceeds. There's been a lot of discussion about that, but that's how the SBA's regulations read. What I am hoping is that when we get, and if we get the new regulations and guidance from the SBA on the loan forgiveness piece, there'll be some additional guidance or even additional regulations available to us as to how the any outstanding balance of the loan proceeds should be used that are not subject to forgiveness. But based on the regulations that came out in mid-April, there is a section about how can PPP loans be used, and that the language in that section very much suggests that the allowable uses of the CARES Act and the new 75% 25% ratio that's established by the regulations applies to the use of all loan proceeds regardless of whether portions of the loan are forgiven.
All right, last two questions and we'll wrap up. The first one, this has been asked in several different formats. When we start talking about things like rent and utilities, the questions that have been asked include things about leases on vehicles that are used for the business, such as delivery trucks, things like equipment that is rented in the warehouse or distribution center, software that has subscription fees, all obviously business expenses. Has the SBA given clear definition of what can be considered those utilities and those items under a per se lease?
No, and I hope that they still will. The definition, the word rent has not been defined yet, either in the CARES Act or in any of the subsequent regulations or guidance. Neither has the term lease agreement. So it's really not clear whether rent and lease agreement is limited to real property at this point, or whether it could be expanded to include things like, a fleet, for example, or equipment rental. And as to the utilities, there has been some definition of what utilities mean, but I haven't seen anything that specifically addresses whether for example, licensure costs or subscription costs for a software program might be considered among the utilities that would be in the forgivable costs. But please add that to that second section about the second question about the utilities and licenses for software, that sort of thing. Please add that to the list of follow-up questions. And I can check that one a little further. But I do know that, and I've checked very recently, that rent and lease agreements have not been specifically defined, nor have they been limited to, at this point, real property. And I really hope we're going to get some more information on that.
Certainly hope so. And our last question that we'll be able to get to here, and then of course, as I said, you will have the ability to send those in to ask. The question's also been asked here, will access be granted to this website after it concludes? And it absolutely will. We will have access to this available for those in attendance today. So our last question, Jill, we've been asked several times in several different formats about paying our team members as they return or as they've stayed on staff a little more than they were being paid before. Also mentioning things like hazard pay for employees who are serving out there on the front line. Is there anything in the PPP that says we can't pay them? We know we can't reduce their wages more than 25%. Are we allowed to pay them a little more than we were paying them prior to coronavirus?
Absolutely. The government will not penalize you for paying your employees more during the pandemic. And that could include either perhaps a premium pay, almost like a shift differential for an hourly employee, or even a salary employee where they're being paid a little bit more for working through the pandemic. situation, it could include, pay increases that you might put into place either as part of your regular process or perhaps just to reward your employees for performing well during this time period. If you increase the amount that you pay either overall in payroll costs or to any specific employees, you won't be penalized for that. And as with the bearing in mind that you've still got the $100,000 limitation per employee on the amount of loan forgiveness you can receive and the amount that should be considered as part of overall payroll costs, any increase should not hurt you in terms of these loans.
All right. Thank you so much for that answer, Jill. And on behalf of the members that are here today, thank you so much for lending your experience and your expertise to us. It is extremely helpful as we navigate through these unprecedented times. And we certainly appreciate all that you've done so far. And we're very much looking forward to continuing to work with you as we navigate toward a back to business state, as we start to see that light at the end of the tunnel and get back toward a new normal. We know there's a lot more to come, so we certainly appreciate your time today.
Hey, thank you. And thank you again for joining us, everybody.
And to the members on the call, thanks so much for spending some time with us this afternoon. If you have further questions and you'd like some additional answers, please send those to ask@nationwidegroup.org, and we will get those processed for you as quickly as possible. We do hope that you, your team, and your families are doing well. And if there's anything at all that you need, your Nationwide team stands ready to serve. Please feel free to reach out. Have a great afternoon, and thanks again.